Hello, Connie here from Prosperity Finance. I hope you're well. Have you noticed the change in the property market since the government housing rule announcement coming out? I think it's still early to say how that new rule impact on the overall property market, but definitely I heard a lot of people worried about the new rule. It's not helping the first home buyers and at the same time painful for investors. Anyway, what I'm going to talk about today is with the investment property, you can no longer deduct the interest expense against the rental income. Now, as a result of that, you would expect you have less cash flow in hands. So what I expect the bank to do is they're going to review their servicing calculator and make it tougher for people to borrow if you are buying investment property, or if you're buying home but you have existing investment property, both would get affected because they are going to make changes to how the rental income are calculated. So if you have existing rental or you have a future rental, you will be affected by the new lending rule. Now at this stage, no one knows what these changes are, but what concerns me is that I still see a lot of people have multiple property secured with one bank. I always tell people don't do that. There's a lot of a downside. So now it's become more important that you have a splitting bank strategy. Now here I quickly summarize why it is important to have your property split with the different banks. So number one is to do with the borrowing rule. So every bank has their lending rule. They can be quite different in terms of borrowing capacity from one bank to the other. Now, also with the upcoming lending policy change that for investment property income, I'm sure they have some different policy. So if you stick with one bank and their policy are really tough, then potentially you will be punished. Your borrowing capacity could reduce dramatically compared to the structure that you have property with the different banks. So that's to do with the borrowing capacity or lending rule. Number two, if your family home is secured to the same bank as your investment property, then anything wrong with the investment property lending, then your home get affected. So you don't really want to lose your home, right? So make sure your family home is always separate from other securities. Okay, so that's about the family home. Third downside is, and it happens all the time, I heard a lot of sad news, is when you sell a property, the bank will reassess your borrowing capacity and they will tell you how much you have to repay. It's actually not the amount you borrowed for the property you're going to sell. Basically, the bank take a overall approach. They add up all the loans and all the income and all the security value, then they reassess. So the worst outcome is you have to pay everything with your sale proceeds and left nothing to do anything else that you plan to do. So that's really, really important if you're going to sell property, but they also have other cross-secure with other properties. Now the next one is to do the interest rate change. Before there was a bank, they have a different pricing for owner-occupied property and investment property. They charge a higher rates for investment property, but the other banks treat them the same. They only have one pricing. So if you go to the wrong bank and have everything with one bank that has a high interest rate, then potentially you'll pay much more than having a split bank strategy. Now, lastly is to do with the cross guarantee. If you have multiple entities within one bank, you have your joint names or your own name under a property ownership, and then you also have the company structure or family trust structure, then effectively they all secure with each other. So it diminishes the protection aspects. So you may have a property under trust, but it's guaranteed the loan for a company. So you're not really take a full advantage of family trusts in terms of asset protection. So these are the downside for having your property with one bank. So it is important that you review now before the bank change the borrowing capacity calculation. Now, normally when we consider splitting banks, we will make a thorough assessment. So firstly, we'll look at your equity level and see if it's enough equity to split the banks. And then if so, then we will ask you, what is your plan? Do you have a property will be sold in the near future? Would you have property to be developed? If so, then we'll try to keep them separate so other property will be unattacked. Okay, and also, as I mentioned earlier, I normally recommend have your home just mortgaged to a bank that has no control over other properties. So your home is kind of isolated, has nothing to do with the other property. So max out the protection. Okay, so really case by case. So we'll work with you and to understand your situation and plan so that we can come up for the new structure that help you to protect your assets and also help you to minimize the impact by future lending rule changes. Now, lastly, I'll just quickly mention about the cost. So when you do the splitting, you potentially will have 3 types of costs. One is solicitor fee. When you do discharge or refinance, there will be a solicitor fee involved. You need to ask your solicitor about that. And second cost would be break cost if you move your loan while it's on fixed term. Okay, because you sign a contract with the bank and say, I'm paying these amounts every month at these rates. If you break the contract, you have to pay break costs. It's very easy to find out the break cost just by contacting your bank directly. Now, the last thing is about the cashback clawback. So, you know, when you borrow money from the bank, they give you cashback. But you have to stay with the bank for a number of years. So it ranges from 2 to 4 years. So if you leave early, potentially they will charge you that fee. Hopefully, when you refinance to a new bank, they will give you cash back. That's enough to cover this cost. But it's really down to individual case, and we can help you to analyze all that. We also look at any property can be discharged. The capital growth very strong over the last 12 months. It's very likely you have enough equity which allow you to discharge one or more properties. So we will help you to review your property portfolio and come up with a plan that suits your needs. Okay, so hope you find this video useful. It is really important that you take on board suggestions in this video and start reviewing your property portfolio and your loan structure. We are very happy to help you to review and give you our expert advice. Thank you so much. I will see you next time. Bye-bye.